So more and more people that are looking to borrow money are being rejected. In fact, back in June, more borrowers got rejected for loans at the highest rate in 5 years. So if you're someone that's looking for a mortgage, nope, not gonna happen. If you're looking for an auto loan, nope, rejected. Let's say you're looking for a credit card, nope, can't do it. But if you're looking for hundreds of thousands of dollars in student loans, they got you, right? Like don't matter the amount, just let them know how much you need, when you're gonna pay it back, and they got you, right? It's just, and I find that crazy that people they allow people to borrow $100,000 of student loans, but you have more and more people like not being qualified to borrow, to get an auto loan or a mortgage or a credit card, and it's crazy why that is. But I mean, that's another video for another day. I can break down why that is, but that's obviously not the purpose of this video. So in this video, we're talking about how more and more borrowers are getting rejected at a higher rate in 5 years, and the reason why that's happening is obviously because the Feds, right? They're jacking up interest rates. They want to reduce inflation. And what they really want is obviously, and the reason why they're obviously raising interest rates, because they may not say this, but one of the reasons, obviously, they want people losing their jobs, right? They want people to lose jobs, and also by increasing rates, they want to make borrowing money more expensive, because obviously it does two things, right? If people are losing their jobs, then that's less money that's being put in the economy, which is driving up demand. So if there's less money to buy things, then you'll see demand come down. So they want people out of work, so that's less money being put in the economy. Now, to make things more expensive, because if things are expensive, then people can't afford the things to buy. That's also going to drive down demand, right? If I can't afford to buy certain things, if people can't afford to buy certain things, then demand for that is going to come down. So those are like some of the reasons why they want to do it, and why you see the Feds like jacking up the interest rate. They want to make debt very expensive to borrow. So that's going to, once people say they can't afford something, they see the price of something is too much, they just say, you know what, I can't afford it, and that's going to drive down the demand. So let's just get into this article, some Market Insight, for why, some of the reasons for or how they're going about making sure that they drive down inflation. So it's like, all right, so for anything from credit cards to auto loans, lending conditions are getting tougher and tougher for Americans. A recent New York Federal Reserve survey found that the overall rejection rate for credit applications increased 21.8% year over year in June. That's the highest level since June 2008, and the increase hit every age group from weighted most on those with credit scores below 680. So if you're someone obviously with a low credit score, obviously below 680, it's going to be even tougher for you to get approved for any type of loan. Because obviously they're going to look at that and say, all right, this person is a credit risk, right? Can this person afford the loan that they're given? And you see these banks, and they're very tight with their money, because obviously they're very cautious about what's going on with the economy. They think there's going to be a recession. They're very strict on cautious about who they're giving their money to. They want to make sure that you can afford it, right? So you're going to obviously have to have a high income. You're going to have good credit. They want to make sure that you can manage it. So they're going to be looking for certain criteria to make sure that this person can borrow can pay back the money. And especially in this environment where everybody is struggling financially, everything is more expensive, they're going to be very cautious with who they give their money to. So if you're someone that's a 680 score, you got to figure out why your credit score is at that level, right? Is there any way to make it higher? Do you have some credit cards that are in default, or they have they're near their credit limit? So you want to figure out why that's happening, and obviously correct that if you're someone that's looking to purchase a home, or auto loan, or looking for a credit card. So a variety of reasons, you want to make sure you fix that, because if you're someone with a below 680 score, it's gonna be difficult. So it says, it's been over a year since the Fed first started raising interest rates to combat historic inflation. After 10 consecutive hikes, policymakers opted for the skip in June, but many analysts see more hikes still to come. There's supposed to be 2 more by the end of this year. So it says higher borrowing costs are meant to discourage spending and, as a result, cool down the economy and tame inflation. Like I said, the reason why they're doing that, because they want to discourage spending, right? They want to make sure that you don't have any money to spend in the economy, right? And the less money that's being spent in the economy, that's going to drive down demand, which is also going to drive down inflation. So this is their goal. So, but the rate hikes also make general business environment more difficult as well, which we saw manifest several months ago across a slew of bank failures, starting with Silicon Valley Bank. Since then, credit availability has tightened significantly as banks shore up deposits and become less willing to spend. So it says the Fed surveys highlighted the pain that individuals are feeling. All types of loan applications have seen higher rejection probabilities. Auto loans, for example, saw a rejection probability of 30.7%, while mortgages and credit card limits increases stood at 46.1 and 42.4 respectively. So given the tighter lending conditions, many have stopped applying for loans altogether, right? So that's where it's going to get to a point where you see what they're doing is working already. So they're going to say less people are going to apply for these type of loans, which is going to drive down demand for loans, which is also going to help with inflation. So this is their goal. This is what they want to do. Obviously, right now, the labor market is still tight, but I think that's slowing down as well. But they want to see more people. They want to see unemployment go up. Even though they won't say that, they want more people unemployed. That's less money, like I said, in the economy. It's going to drive down demand and hopefully drive down inflation. So it says the application rate for any kind of credit over the past 12 months declined to 40.3% from 40.9% in February, its lowest reading since October 2020. Fed researchers said application rates declined to 11.9% for auto loans and 12.5% for credit card limit requests, but increased to 24.8% for credit cards, 6.5% for mortgages, and 5.3% for mortgage refinance. So basically, like, look at. Right now, obviously, it's not the best time. If you're someone that's looking to make a big purchase, obviously it's not the best time to do that. Unless your finances are really good, that's something I would not advise. Because obviously things are just so expensive. Like anything that you're trying to get a loan for is just going to cost you so much money. Whether you're looking for a mortgage, whether you're looking for auto loan, credit cards, the interest rates on these things, it'll be so high. So I think it's like, obviously, if you don't need it, I wouldn't make that purchase. Especially if your credit score is low. A lot of people are just gonna reject that, as you can see. But obviously right now is just not a great time to be making big purchases when the interest rate is so high. So but yeah, so it's gonna be interesting to see like how, obviously, when they do the interest rate hikes, the next two that they're gonna do at the end of the year, how much is gonna go down, because like I said, the goal is to drive down demand and thus hopefully drive down inflation. And as you see more people being rejected for loans, which is the goal. Hopefully, from what they'll see the inflation rate go down. So that's what I got for you guys today. If you got any comments or questions, make sure to leave it down below. Hit the like button, share, and if you haven't done so already, make sure to subscribe. All right, so you guys take care and have a good one. Later.